Okay, I'll talk a little bit about just some of the metrics that we should be. Let me look at sharing my screen quick. Hold on. Perhaps what I'll do here is I'll talk a little bit about term sheets that entrepreneurs should be aware of when talking to VCs. That seems to be a very pertinent thing these days. So let me just pull that up and talk about some of the pitfalls of term sheets. Let me just quickly share my screen. Give me a second. Okay, can everyone see the screen that I have up? It should say key term sheets that are to be standardized. Does everyone see that?
Yes, we can.
Okay, hopefully the font's not too small. Okay, I was asked to talk about VC funding in Africa and the fund that I'm part of, but I'm going to rather speak about some of the terms that entrepreneurs need to be aware of when they talk to VC funds. It's something that there's a big conference happening at the moment called Africa Arena where this has come about quite a few times. So I'm going to speak about things to avoid as an entrepreneur when you talk to VCs from a terminology perspective. So again, I don't know who's in the audience and what the feel is like, but if there are entrepreneurs in the audience, this is probably very helpful to you. Okay, when you look at term sheets, there are a lot of legal terms and jargon that should be second language and second nature to you as a founder, but often we overlook them and assume that it's not that important as long as we know how much money we're getting and what valuation we're getting it at. That's not true. Term sheets have a lot of hidden clauses in them that can make or break your business. So one of the things that, and by the way, please, if people have any questions, please feel free to interrupt me. We've got 20 minutes, but I'd like this to be as interactive as possible. So you've got two classes of shares, broadly speaking, when you raise capital, common shares and preferred shares. Common shares are typically a class of shares held by founders and employees, and they rank behind preferred equity and debt investors that have voting rights. Preferred shares are usually associated with a liquidation preference and are used to raise capital in early rounds of funding, Series A, B, and C, and beyond. One of the important things that preferred shares carry with them is two clauses. They have a liquidation preference and they have a participating right. Liquidation preference is essentially determining who gets paid first and how much they get in a liquidation event. When a company goes through a liquidation event, which even though it sounds like a negative thing, a liquidation event is a sale of a company, it's a winding up of a company, it's a forced sale. Preferred shareholders typically get paid first before ordinary shareholders, and this makes this quite an attractive term to protect VC investors. In the 80s and 90s in the VC industry in the US, you would see term sheets where liquidation preferences could go all the way up to a 3x, and seeing a 2x liquidation was not unusual. In today's world, over the last 10 years, anything more than a 1x liquidation preference is a big taboo and a big red flag. And that sort of brings me to the next part of it, which is your participation rights. Now, what participating rights essentially means is preferred shareholders are entitled to receive a share of any remaining liquidation proceeds after they've already received their liquidation preference. So in colloquial VC speak, that's often referred to as double dipping, which essentially means I'm guaranteed my capital back as a VC in a liquidation event. And I also have upside on any proceeds beyond my liquidation preference. So as an example of that, if you look at a scenario where, let's say I'm a VC and I invest $1 million into a company at, say, a pre-money valuation of $4 million. So I get an effective 20% stake in the company. So my pre-money is 4, my post-money is 5, so I own 20% of the company. Now, if the company were to sell for, say, $10 million in 2 years, you have a buyer that buys the company for $10 million. If I have a 1x liquidation preference, which is pretty standard for a Series A, Series B, or Series C round, and I have no participation, which is also standard and ideal from an entrepreneur's perspective, when the liquidity event happens, I, as a VC, get to choose between either exercising my liquidation option or converting my preferred shares to common shares on a 1-to-1 basis, which is the norm, and getting a percentage of the proceeds. So in this particular case, I have a 20% stake in the company, 1/5. If the company sells for a $10 million exit in a couple of years or 3 years or whatever, I can either get my $1 million back or I can get 20% of the exit because I convert my preferred to common. And I would pick the latter, right? The evil double dipping clause, which is called participating preferred with the liquidity preference. So if you're an entrepreneur listening to this and you ever see that line on a term sheet, run for the hills, because it is one of the most dangerous clauses in a term sheet. In this particular case, if the company sells for $10 million, I get to keep my $1 million as my liquidation, and I get to participate on an as converted basis on the leftover portion. So of the $9 million in proceeds left over, I get to keep 1.8 million of that, which is 20% of the balance. That is, and then as a founder, all I have is what's left over. That's a very important clause to keep in mind. You then have the concept of a preferred return, which are dividends that get paid to preferred shareholders above and beyond their stock capital. I'm sure everyone here knows what pre-money and post-money evaluations are. I don't need to spend much time on that. Pro rata rights. Pro rata rights essentially give an investor an option to participate in future funding rounds to maintain their level of shareholding and avoid dilution. So these can be quite problematic for founders simply because you're allowing an investor in the previous round to top up their shares and essentially prevent themselves from being diluted. And at the end of the day, you get diluted as the founder. It's a pretty standard clause, which allows investors to keep their existing portion, but the dilution happens to you as a founder. Important things to keep in mind here are tag along and drag along rights. These are essentially things designed to protect minority shareholders. A tag along right allows a minority shareholder the right to follow a lead shareholder in an exit transaction. And drag along rights protect majority shareholders that allow them the ability to force minority shareholders to join in the sale of a company. And that's particularly helpful when you have a cap table that has lots of minorities. Anti-dilution clauses are used a lot. They essentially protect investors from diluting should the next round of funding be a down round. And down round is essentially when you raise a subsequent round of funding at a valuation lower than the last round of funding. As an early stage entrepreneur, when you raise capital, you want to make sure that you raise capital through instruments that are as founder friendly as possible. So unless you're at a point where you're doing a Series A round, where your round is priced, it is very, very, well, it's highly advisable to raise money through either a safe note or a convertible note, which essentially says you invest a certain amount of money into a startup that converts at a predetermined cap or a discount to the next price round. That is by far convertible notes and safe notes on the next slide are two of the most popular funding instruments that are used by startups all over the world in getting access to funding quickly, efficiently, and from a very price, and from almost issuing a convertible note from a legal standpoint, and certainly a safe note, costs almost nothing. A lot of entrepreneurs that raise capital are often given terms around no shop agreements. Although it is something that a lot of founders don't particularly like, a lot of VCs tend to protect entrepreneurs from seeing other investors. The norm from a founder perspective is to restrict this to nothing more than 60 days. You don't want to be limiting yourself to just one investor for a 60-day period and prevent yourself from having no options if they say no. Right of first refusal gives investors a right, but not the obligation to purchase shares at an offer extended to third parties. It's a very simple clause and a very common clause that investors have. And then you have a clause called ratchets. Now, ratchets are often used by both entrepreneurs and investors. And what ratchets essentially do is they peg the valuation of your company to certain key achievable milestones. So, for example, if I were to invest $1 million into a company and the entrepreneur says that, my valuation post money is 5 million, but I think as an investor that it should be a lot less. What then happens is you create or you look at certain metrics like saying, I will invest at a valuation that is equivalent to, let's say, 5 times your annual revenue. So I'll give you a $5 million valuation, provided that in the next 12 months, you can hit $1 million in revenue. So I'll give you 5 times your revenue. And at the end of 1 year, if you've only hit half of your target, then I get issued more shares to give me the same equity holding. So ratchets are basically a way to protect early stage investors by ensuring that their percentage ownership is not diminished if certain milestones are not achieved. A final clause that I'll talk about is vesting, and it's very important for founders to be aware of this. A lot of founders often come to me and ask me, how do founders have the right to own shares, and how do companies protect themselves from certain co-founders leaving the company early? So founders are required to earn the right to keep their shares, and that's usually between 3 years or 4 years of financing. So if I'm investing money into you right now, I want to make sure that you as the founders stick around for at least 3 to 4 years. And one way to sort of control that is by limiting how much equity you get as a founder to keep if you leave early. So there is a concept of a cliff and a vesting schedule. So what that means is if you have a 4-year vesting schedule and a 1-year cliff, that means that over the course of the first 1 year, which is your cliff, you don't get to keep any equity in the company. And then beyond that, your equity vests over a period of time. So if you're a founder or a co-founder and you have a 30% stake in the company, your 30% isn't given to you up front. You earn that over your first year, which is your cliff period. And then at the end of year 2, if you leave the company, you only keep 10%. if you leave at the end of year 3, you keep 20%. And if you leave at the end of year 4 or stay on forever, you get your entire 30%. So vesting is a very important feature that VCs ask as part of their term sheets. And then just one very important thing to sort of conclude here is the fact that, or the importance of you as a founder knowing that your valuation is not really determined by anything apart from how much validation you have on your product. So if you have a good product market fit, or you have a good problem solution fit, that's the only thing that really determines how your value or what the value of your company is. I've seen way too many founders that are so fixated on how much money they've raised before or how long they've been in operations. The reality is, no matter how long you've been in operation or how much money you've raised, you're only valued as much as what your customers validate of you. So the only true measure of your value, of your valuation, is validation. So yeah, those are just some highlights that I wanted to share with you. If you're an aspiring founder or you have an existing business and you get term sheets from investors, what you should be aware of before getting into further discussions and negotiations. Myself personally, a bit about myself. I was an investment banker for several years, got my MBA from Stanford, and I've been in South Africa for the last 10 years. I ran one of the largest accelerators for technology startups in Africa called Startup Bootcamp. And I'm one of the most active angel investors in African technology startups with a portfolio of more than 50 companies. And I've just launched the largest Pan-African seed VC fund called Launch Africa. We've gotten past our first close and are actively investing in startups all across the continent in multiple sectors, and are looking for both interesting companies to invest in, as well as for investors that want to join Africa's largest seed fund. So that's a bit about us. Happy to take any questions if people have questions. Otherwise, yeah. It is Friday afternoon somewhere in the world. It certainly is Friday afternoon here, so in Cape Town in South Africa. So completely understand if people have other things, have better things to be doing on a Friday afternoon. Remy, is there anything else from your side?
No, I think that was it. You covered quite a few things. So yeah, thank you so much. That sounded
okay.
Good. Yeah, thank you. Hope everyone got something from it.
Okay, great. Thanks very much. Remy, do I have another session later today?
I'm going to have a look and to see. There's a few sessions running concurrently, so I just have to have a look.
Okay.
Yes, we'll let you know. At 4:15. 4:15, she said, yeah.
4:15 GMT. Okay.
Yes.
All right. Do we know what that's about?
Yes, we'll communicate with you.
Okay, great. Perfect. Okay. Thanks, everyone.